U.S. Federal Reserve meeting outcome. Barclays says a Fed rate hike remains the base case. To talk about that and also the impact of Donald Trump's presidency, we have Ajay Rajadhyaksha, MD and Global Head of Macro Research at Barclays, right here in our studios. Ajay, good morning. Good to have you here. Yeah. I believe you're based in the U.S. So, that's right. What's been the ground feedback? We have seen, of course, the markets make new highs and have a huge rally. But overall, what's the sense in U.S. right now?
So from a financial and macroeconomic standpoint, the sense is that this is the first time in a long time that a Republican administration is controlling all three levers, which is the presidency as well as both the House and the Senate. The expectation is that President Trump will pass a big fiscal expansion package, and as a result, at the very least, the U.S. business cycle should not just pick up but lengthen for another several quarters.
Okay. Well, Ajay, actually, good to have you with us on a very strategic day. Does this big rally and noises of fiscal spending and improvement of the U.S. economy feel like 2003? That we're going to see global growth and therefore the rate hikes will be taken in the stride?
It's not clear yet because so far the markets are trading on hope, right? What they're essentially saying is, if you look at the Trump agenda, there are two parts to it. One is fiscal expansion, but the other is a raising of trade barriers, right? And the markets are right now saying the first will be implemented in spades and the second, not so much. That's just symbolic. And I think we have to wait to see how that actually plays out. The other thing to remember is that even though there is consensus around fiscal expansion in the United States, the place that needs it when I look at the global economy is actually Europe. And you're not going to see fiscal expansion in the European Union anytime soon.
Okay. Ajay, good morning and thank you for being with us in our studio. Let's talk about the event now, which is the FOMC. Yeah. And we were speaking in the break about how the Republicans are perhaps trying their best to impinge on the Fed's independence. And that's not unexpected. So do you get a sense that today's event could in a way just be a non-event for the market?
I think today's event will be a non-event for the market. Markets are pricing in a Fed hike with almost 100% certainty. I would be shocked if the Fed doesn't deliver, because not only are they now looking at a world where fiscal expansion is very much likely to be a reality, something that they have been calling for a while, right? But the US economy is at full employment and we are still at interest rates that historically have corresponded to near crisis levels. So it's time to get on with the hiking cycle.
Okay. What's your call on the dollar and the bond market? Because we've seen a big strength in dollar, of course. We've seen how the US bond market has moved. In emerging market also, we have seen a big bond rally as well. Your thoughts on that space?
We think dollar strength has more room to run. The dollar has strengthened trade weighted about 5.5% to 6% this year from the lows of the year. For context, between the second half of 2014 and the end of 2015, the dollar trade weighted strengthened about 20% in a period where the Fed consistently disappointed when it came to actual hikes versus what they had promised. So this time around, I think they're far less likely to disappoint over the next few quarters, and that should give the dollar support. It's the one major economy where the central bank is moving higher and the currency should follow.
So what does that mean for emerging markets then?
I think emerging markets on the currency side will still struggle. Again, you have to pick your spots. Emerging markets are a big asset class now. The funny thing is, they have, at a macro level, emerging markets have done some things right coming into this hiking cycle for the US. The first is, at the sovereign level, most emerging markets do not have a lot of dollar-denominated debt, right? That's the one kind of debt that you cannot print your way out of because you can't print dollars. The second is that emerging markets, in many cases, have resisted fiscal expansion that is deficit financed. Countries like Brazil and Russia, they just took their lumps, which is a positive. And the third is, so far, currencies had stabilized over the last 12 to 18 months to the point where the pass-through from inflation was largely done. So you could have argued that emerging market central banks were one of the few areas where central banks had room to ease further. Now that's gone away, admittedly, but it still is a support factor.
Since you are based in New York, I wanted to understand from you what the mood is like with respect to foreign investors and long-only funds reacting to the demonetization in India. Are they as spooked as some of the domestic community is?
I think opinion is split. there are those who believe that ultimately, if this reduces rent-seeking behavior, if it gets the underground economy back as part of the broader, above ground economy, if you will, it's an overall, medium-term positive. Virtually no one disputes that it's a near-term negative, right? Not just in terms of inconvenience cost, but also in terms of actual hit to economic activity. And virtually everyone agrees that the execution arguably could have been handled a little bit better.
Okay, I want to come back to this rising dollar. Will it play out like 2004, 2005 when a rising dollar rose all boats, pulled up all boats? Or will it play like the taper times of 14, 15, where there will be severe financial disruption in 2017?
I think the truth is probably somewhere in the middle. I definitely do not think that a rising dollar is going to lift all boats. What we have seen over the last few years is that a strong dollar seems to be a negative for the world economy, because a strong dollar seems to go hand in hand with capital flight out of emerging markets, and as a result, financial market volatility picking up. Like you said, the examples of August 2015, Jan 2016. But like I said before, right, we've only had about a 5.5% move. It seems like a lot, but we had a 20% move over the 18 months prior to that. So there's some room to go before we start to worry.
Okay. Will the renminbi worry you? Because that is where the trouble started in August 2015 and Jan 16.
The renminbi over the medium term is something that we watch very, very, very closely. In New York, I think you guys will have a better appreciation of this. Sitting in New York, many investors do not. At this point, China is arguably the single most important economy in the world, including the United States, even though it's a somewhat smaller economy, given its contribution to world growth, given how much more intertwined it is with the rest of the world economy, etc. And so far, they have managed to depreciate the renminbi versus the dollar while keeping it unchanged versus their own basket, right?
That's right.
While preventing a lot of capital flight. But remember that as the turn of the year comes, every Chinese citizen is allowed to move $50,000 out, and they typically exercise that early in the year. So you could see a repeat of what happened last November, December, Jan, in terms of just noise around capital flight picking up from China. I do not think that they will let the renminbi go, so to speak, right? For example, one of the questions that I keep getting asked is, well, if the United States declares China a currency manipulator, does China react by saying, fine, here, you don't want us to, do anything, hands up, and as a result, the currency weakens? That is not the approach that we think the Chinese will take. But if you see the one China policy being questioned very significantly in the United States, that I think is a whole different ball of food.
Okay, Ajay, we've actually run out of time, but thank you so much for joining us. It was an absolute pleasure speaking to you and hearing your thoughts about the global markets.